And now, with Sound Investing, here's Paul Merriman.
The following is my reading of Chapter 4 in Financial Fitness Forever. The title of this chapter is, Will You Try to Beat the Market? And it starts with a quote from Frank Hubbard. The safe way to double your money is to fold it over and put it in your pocket. I could make a case that this is the most important fork in the road for investors. If you take the wrong fork here, which in my view is trying to beat the market, you will be likely to make the wrong choices everywhere else. The chapter title poses a question, and your answer will affect everything else that you do. Wall Street and Main Street, for different reasons, hope you will try to beat the market. I hope you won't. Beating the market hurts. How does trying to beat the market hurt investors? If you are determined to beat the market, you will likely place much more trust in Wall Street and Main Street than is good for you. You will pay higher expenses and fees than are necessary. You will probably pay more taxes than are necessary. You will take more risk than is necessary to achieve the return you need. You will fail to diversify properly since you'll come to believe or even know that you have the market figured out. And you might start thinking that diversification is only for dummies. You will almost certainly spend more time fretting over your finances than you need to, and this anxiety will rob you of peace of mind. You may chase performance by investing in 5-star funds at Morningstar, most of which have had average or below average performance after they attain that rating. You'll have your eye on short-term trends rather than long-term returns. You'll find yourself susceptible to whims, fads, trends, and emotions. Because your focus will be on competition rather than on what you need, you'll have no idea when to stop, when you have reached the point that enough is enough. One very reliable way to beat the market, at least some of the time, is to put your money into a money market fund or a bank certificate of deposit. History shows that the stock market goes down approximately 1 day out of every 3, and in about 1 of every 3 calendar years. If your money were in a money market fund or a CD during those times, you wouldn't lose. You would beat the market. Hundreds of times over my career, people have asked me, wouldn't I have been better off in CDs? The answer is often yes. But it's not a useful answer because we can't invest retroactively. If we wanted CD returns, you could have taken your money to the bank at the start of whatever period you're asking about. However, I can't recall anybody using the phrase beat the market to describe why they would invest in CDs or money market funds. People who want to beat the market are hoping to make big money. So what about you? Are you determined to go for it, or are you willing to accept the returns of the market? The first choice will put you on a roller coaster ride with an unknowable landing. The second won't guarantee a smooth ride, but it's much more likely to provide an outcome you want. How will you make this choice? I suspect your emotional makeup may play a bigger role than all the arguments and evidence I can give you. Neither you nor I nor anybody else can know the future, and it is theoretically possible that your market-beating efforts will lead to a great success. But it's much more likely that those efforts will eventually lead you to give up after you have misused a lot of precious time and lost a lot of precious dollars. That's the bad news. But there is good news too. The good news is that you can be an above-average investor. If you are willing to do that, then you're in luck. Becoming an above-average investor. In theory, it should be easy. If you want to replicate the U.S. stock market as represented by the Standard & Poor's 500 index, you have a choice of a low-cost index fund and exchange-traded ETFs. The same holds true for most major asset classes that I recommend. However, in real life, two things keep investors from achieving those returns. The first thing that gets in the way of achieving market returns is Wall Street itself. Various expenses, fees, and inefficiencies are inevitable. At a very minimum, somebody has to package an index, make it available, and keep records. This cumulative drag on your performance isn't always easy to see, and it comes in many forms, including taxes that in some cases can be avoided or postponed. One academic study of investors' returns over a quarter century concluded that these factors reduced actual returns by about 2.5 percentage points. Some of this simply must be accepted. But every 1/100th of a percentage point of return that you keep or that you give up can add up to thousands of dollars over an investing lifetime. Savvy investors pay careful attention to the expenses they pay. They do their best to pay only for what is truly necessary or beneficial. The second thing that gets in the way of achieving market returns is the behavior of investors. Because this behavior is within our control, the rest of this chapter is focused on this topic. Investors trying to beat the market inevitably put their money into funds that have had recent hot performance. It's fairly easy to identify such funds, many of which have ratings of 4 or 5 stars at Morningstar. Financial media love to focus on 5-star funds, and their audiences love to be introduced to gurus. Mutual fund companies love to advertise their 5-star funds because they know investors feel most comfortable investing in something with good recent performance. Morningstar denies that its fund rating system has any predictive value, and multiple studies have shown that in the years after a fund attains 5-star status, such funds tend to have average performance at best. This inevitably creates disillusioned and disappointed investors, who often take their money out after a few years and put it back into other 5-star funds. If you could read the questions I get from investors, you'd see how difficult it can be to make sound decisions when you're worried about short-term trends and developments. Let me quote from a query that came in via email while I was writing this book. It's from a 59-year-old woman, I'll call her Michelle, who says her portfolio is 100% in equity funds, most of it in Vanguard index funds. She writes that she is pleased she has an average expense ratio of 14/100%, and I have to agree that is very favorable. Quote, obviously, I know I should have a percentage of my portfolio in fixed income, and I was planning to do this in the past couple of years, Michelle wrote. But with the downturn in the market and lower interest rates, I did not want to sell stocks at lower values and worry about moving into bonds when interest rates were poised to rise, unquote. Then came her questions. Quote, what is your opinion? Should I wait for rates to rise and then buy into bonds? Should I make the switch gradually through dollar cost averaging? Or should I take some other course? End quote. Michelle wants to do the right thing, but in my view, she is asking the wrong questions. At 59, she's got an investment future that's likely to last 20 to 30 years, maybe more. I can't fault her for wanting to avoid buying bonds just before their prices could decline in response to higher interest rates. But in focusing on these short-term concerns, Michelle seems to be neglecting something much more important, her longer-term need to reduce the risk of owning a portfolio full of equities. And the best way to do that is by owning bond funds. Michelle obviously understands that. But she can't take the right action because she's so intent on getting her timing just right. Her biggest concern seems to be how to wind up with the most money in 3 to 5 years from now. Nobody can tell her how to do that. Maybe she'll do best if she shifts a big chunk of her portfolios into bonds right away. It's also possible she will do better if she waits for a few years to see what happens. But that would not really solve her problem. Instead, it would leave her with another question. When will she know the time is right to make the move? Unfortunately, she probably won't know until it's too late for her to take advantage of that right time. As you can see, it's easy to get tied up in knots over this issue. When we finally do act, it is often the result of emotions more than evidence and rationality. Timing decisions. Taken one by one, each of our timing decisions seems like the right thing to do at the time. But collectively, investors lose billions of dollars as they try to get into and out of the market at the right times. That's a startling statement, and I have evidence to back it up. Although it doesn't seem logical, as a whole, we investors get a lot less than the returns of the mutual funds in which we invest as we move money in and out of the market based on our fears, greed, and hunches about the short-term future. For many years, a research firm in Boston named DALBAR, Inc. has published a study comparing the reported returns of mutual funds with the average returns of the shareholders in those funds. The firm's figures indicate that during the 20 calendar years ending in December 2010, investors in U.S. equity funds achieved only 41.9% of the annualized return of the S&P 500 index. In those 20 years, the index had an annualized return of 9.1%, while the average equity fund's investors' comparable return was only 3.8%. There are two reasons for this. The first is our in and out timing decisions. The second is that investors must pay in order to invest, and many of us pay far too much in expensive funds and sales commissions. By the way, that means a lot of money was invested in ways that achieved far less than 3.8%. And as if this weren't bad enough, DALBAR characterized the figures as an improvement over the previous few years. And indeed it was. In the 20 calendar years ending in 2008, investors received only 22.4% of the return of the index. You might think this is an anomaly, but academic studies have identified the same phenomenon. These figures are so jarring that I believe it's worth your while to look at them in a little more detail. The lost performance happens because of the way investors pour money into funds and take it out. In short, after the market has been going up, read when prices are higher, investors tend to pump more money into stock funds. And after the market has been going down, when prices are lower, investors tend to stop making new investments, and many even react by taking money out. You could think of a mutual fund as having two pools of money. One is made up of long-term buy and hold dollars that remain invested in spite of the ups and downs of the market. The second is hot money that investors put in and take out depending on fear, greed, and speculation. Mutual funds report and advertise their performance as what happened to the long-term money. That would be a dollar invested at the end of 1 year that is left until the end of the following year. More often than not, remember, the market historically has gone up 2 out of every 3 years, but more often than not, equity fund shareholders who left their money where it was were the winners. The losers were those who had tried to second guess the market. Morningstar calculates what it calls investor returns for mutual funds, comparing them with the reported returns. This information is available free at Morningstar's website. Here's a hypothetical example. A mutual fund may have a very good performance in the first quarter of a calendar year, gaining 8% from January through March, and then break even for the rest of the year. The fund's return for the whole year in that case would be about 8%. But if investors noticed the great first quarter returns and started pouring money into the fund over the next several months, their substantial new investments would earn little, if anything, and the fund's investors' return would suffer. Here's a real-life example from 2006. Fidelity's giant Magellan Fund had a total return of 7.2%. The investor return in that fund, however, was only 4.9%. In other words, the collective investors in that fund actually achieved only about 2/3 of the return that they could have had by investing their money in the fund for the full year without additions or withdrawals. Peter Lynch, who achieved legendary status during a long, successful run as Magellan's portfolio manager, once remarked that more than half the people who bought shares in the fund under his watch lost money because of their in and out timing. Before leaving the Magellan example, it's interesting to think about why investors put their money in that fund to start with. I think it's mostly because they hope to beat the market through Fidelity, stock picking, and active management. How well did those investors succeed? To decide for yourself, think about this. In that same year of 2006, Vanguard's 500 Index Fund reported a total return of 15.6%. Morningstar calculated the fund's investor return as 15.3%. To recap, the S&P 500 goes up 15.6%, and investors in Vanguard's index fund achieve 98% of that. In the same year, Fidelity Magellan goes up 7.2%, so much for beating the market, and investors in Magellan collectively achieve only 68% of that, or less than 1/3 of the market return they were trying to beat. So in this attempt to beat the market, not only did the actively managed fund fail, despite the efforts of the best managers and analysts at Fidelity, but investors in that fund failed to get even Magellan's return. Christine Benz, personal finance director at Morningstar, had studied the effect of investor returns. She has found that the greatest discrepancies occur in the most volatile funds. Hot performance brings in money by the bucket load, but when the hot numbers turn cold, the money leaves just as rapidly. The most infamous case I know of involves the Cgm Focus Fund. In the summer of 2009, Benz looked at the reported returns and investor returns for Cgm Focus, which had a risky, concentrated stock portfolio that had produced off-the-charts performance for years. For 3 periods ending July 31, 2009, the following table shows the annualized fund returns and investor returns she found for Cgm Focus. As she pointed out at the time, Cgm Focus's trailing 10-year return suggests that a $10,000 investment a decade ago would now be worth $51,633. The fund's trailing 10-year investor return over that span, however, suggests that the same $10,000 shriveled to $1,585. The difference? All $50,048 worth is attributed to investors repeatedly mistiming their purchases and sales in chasing performance. And the table shows that for 3 years, the fund was down 3.75% annualized. Investor return for that 3 years, down 23.98% annualized. For 5 years, the fund was up 8.83% annualized, and investor returns down 18.34% annualized. And for the entire 10-year period, the fund grew at 17.84% a year. The investor return down 16.82% a year. As this shows, investors can turn a mutual fund's manager's modest loss to a huge loss, and they can turn a fund's superb 10-year performance into performance that can only be described as awful. Unfortunately, this is not just a fluke. Investor behavior. DALBAR has been measuring the effects of investor behavior since 1994, focusing on collective decisions by investors to buy, sell, and switch mutual fund shares over short periods and long periods. Year after year, the firm has found that the average mutual fund investor earns less than the reported returns of mutual funds. One key finding, stated in bold-faced type in DALBAR's 2011 report, quote, investment results are more dependent on investor behavior than on fund performance. Mutual fund investors who hold on to their investments are more successful than those who time the market, end quote. To conduct its study, DALBAR uses statistics showing mutual fund sales, redemptions, and exchanges every month to calculate average investor behavior. The methodology takes account of realized and unrealized capital gains and losses, dividends, interest, trading costs, sales charges, fees, expenses, and other costs that investors might pay. I'm not a fan of active portfolio management, but many investors retain their hope that they have chosen managers who can beat the market. Yet those same investors second-guess that management by buying, selling, and making their own trading decisions. As DALBAR's report states, to take advantage of any alpha, which is essentially additional return, created by portfolio management, investors need to remain invested and must not step in and out of the market. Most investors think of themselves as in for the long haul. But even when they adopt carefully crafted long-term strategies, many of them don't stay in the game long enough to get the benefits. Instead, they react to the market, their feelings, and the non-stop commentary that becomes a 24/7 staple of the financial media, undermining their strategies and their futures. According to DALBAR, in the past 20 years, the average holding period for equity mutual funds was 3.27 years. Let's see. That adds up to 3 years plus 3 months plus 1 week. Investors think this is long-term. The phrase staying in the game makes me think of sports. Imagine a football team that walked off the field when things didn't work out quite as they had planned or expected. How much respect and sympathy would you have for that team? Mutual fund portfolio managers expend enormous efforts determining what investments to make, the right time to buy and the right time to sell, in order to increase returns by a few hundredths of 1%. The DALBAR report says, only to see retail investors give up entire percentage points by poor timing of their buys and sells. Here's another way you can think about this. It's common to report the annual return of a portfolio or a fund using 4 digits, 2 on either side of a decimal point. For example, Fidelity Magellan Fund's return in the year 2010 was 12.41%. In general, a portfolio manager changes the numbers to the right of the decimal point, the ones that make a relatively small difference. Investors, through their timing and stock picking, change the numbers to the left of the decimal point, the ones that make the big difference. Investors routinely ignore the advice of the funds in which they invest to keep their money invested. Says DALBAR, quote, the result is that the alpha created by portfolio management is lost to the average investor who generally abandons investments at inopportune times, often in response to bad news, end quote. Here we are getting back to the behavioral finance territory we visited in Chapter 2, quote, are we our own worst enemies, end quote. So how do we protect our portfolio from our personalities? The key may be to find ways to take a time out, a concept with which most parents will be familiar. I'm not sure that a mandatory waiting period to buy and sell is a good idea. But if you can impose a voluntary waiting period on yourself, you'll be more likely to avoid falling into some common traps. If you have a strong urge to buy, sell, or exchange some investment, and if you're able to stop and think before acting, here are 4 questions to ask yourself. Do I believe that what I want to do will give me a significant benefit without any additional risk? And parens, and if so, do I have evidence to support this belief? Parens. Would I make this decision if I knew I had to live with it for 10 years before I could change? What will this change mean to any level of diversification? Will I be getting rid of an important asset class? Will I be doubling up on other investments I already own? If I'm about to buy something, do I believe in it enough that if it lost 20% of its value, I would want to buy more of it? If you stop to ask yourself questions like these, you may be able to avoid having your emotions dictate your actions, and you may find it easier to resist the temptations to beat the market. I hope that's what happens for you.
That was Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.